Continuing our discussion of bonds, um, the ability to purchase bonds is no different than investing in stocks. Um, the prices are a little different though. They're quoted as a percentage of par. So a quote of 89.75 means the bond sells at 89.75% of par. Since par is almost always $1,000, the price is $897.50. However, when you buy a bond, you must also pay for any interest that has accrued to that bond. So when you buy a bond from a person that sold it, they may have earned some interest. In this example, 37 days has passed since the last coupon payment. So I've earned the interest for those 37 days. On the day you buy the bond from me, you must pay the bond price plus also the accrued interest. In the bond valuation worksheet, again, we can incorporate this analysis. Here we have a bond, 5.25% coupon bond. The required return is 705. Its current price is $777.50, but there's been 37 days since the last payment, which means the actual price to be paid is $777.50 plus the $5.32. So it would cost you roughly $782.82 to purchase this bond. There are many types of bonds. So above we have three basic types: unsecured or debentures. These bonds have no collateral. The only guarantee of payment is the promise. The other bonds here are secured. They have collateral. A mortgage bond is collateralized or secured by the real estate covering the mortgage. Equipment trust is kind of like renting a car. The car is the collateral for that particular kind of a loan. The final kind of bond, though, is something referred to as an income bond. This is guaranteed by the revenue of the project. If the project does not create enough revenue to pay the interest, then this bond will not pay interest. There are some other types of bonds, but they're not really great in number. Convertible bonds allow investors to convert their bonds into common stock. Euro bonds are international investing, of course. The LIBOR that they mentioned here is more of an interest rate than a bond. But this is used by many credit cards when you look at your interest rate. It is always typically the LIBOR rate plus X number percent. What are high yield securities? Well, what does high yield mean? High yield means high return, and as we know, you can only get higher returns with higher risk. So these bonds typically have a rating below BBB. So what happens to companies that they would get such a low rating? Again, there's a low rating because there is implied additional risk. Why? Two basic reasons. One, fallen angels. These are investment grade companies that for some reason have fallen through the rating system. They're experiencing difficulty in sales, difficulty in controlling expenses. But for some reason, they've fallen down the system, if you will. of default risk. Companies that also have a great deal of debt or startup companies could have very low credit ratings just because we don't know much about them. So they have this risk level. We have some companies who are very strong companies that have a great deal of debt. And this great debt puts them at risk. So they may have lower credit ratings because of that. A spread is the difference between two types of bonds, usually with the same maturity. The reason is due to differences in default risk. So the spread is the premium that you get when you invest in the higher debt yield, you get a higher return. That means you bought something at higher risk, but it also means you paid lower prices for it. So why would you want to buy a high yield bond? Would you lend money to someone you thought could not pay? And of course you wouldn't. But what if they were a fallen angel and you think they're turning themselves around? High yield means low price. If they can fix their issues, capital gains are possible. What if they just have a high level of debt or are expanding? This could be an indicator of future profitability and less risk. Now, both of these are opportunities, but what if they don't? This is what investing is all about. How sure are you that these companies will turn around or ultimately exhibit more profitability? What is a zero coupon bond? This bond pays no interest or coupons. The only return is the maturity value. This is an exception, though, to paying taxes when you receive the income. These bonds have an implied income that is taxed as you go. So this is done essentially to discourage high income investors from using them and not paying taxes, right? So again, if you purchase a bond for $683 and it's a zero coupon bond, right? And current interest rates are at 10%, the applied rate is there's a 68% interest there. So if you sold the bond, if you had no appreciation, you would sell the bond for $683 plus the 68 bucks, and you would be taxed on $68 worth of income. If there was a loss, again, you could sell it 683 plus 40, that would be 723. Again, you would be taxed on $40 of income, but now you would have a $28 capital loss. Again, sometimes these are issued by companies, but not very often. Sometimes they're created by investment companies by stripping the coupon from the capital gains for a government bond. How is debt ultimately retired or paid off? A serial bond is where a portion of the bonds mature each year. It's kind of like an amortized loan. Now, if you purchase a serial bond, you will know when your debt will be called. You know when it's not called, it's the wrong word. You know when your debt will be retired. It's part of the arrangement. A sinking fund is less structured form of a serial bond. They can pay off a certain percentage each year, or they can repurchase depending on whether the price was right or not. Again, this is more of a corporate finance question, is when that occurs. We also have something called a call feature. Okay? In a call feature, if interest rates have fallen far enough to provide a lower cost payout for the debt, then they would refinance this debt. Now, this does not reduce debt. It just exchanges one higher rate coupon for a lower rate coupon. So what's this relationship between prices and interest rates? We can look at something, they refer to them here as a perpetual bond. Sometimes in the finance world, they're called consols. It just assumes that the payment's going to last forever. And the nice part of this is it allows us to be able to see how when interest rates rise, bond prices fall. And again, if they fall far enough, they're going to have a price less than 1,000. And if they fall far enough, they'll be here to have a price greater than 1,000. That means they're selling at a premium. And if the interest rates increase dramatically, they ultimately be selling at a discount, less than $1,000. However, at maturity, the value of a bond will always be its par value because they have to pay off that $1,000 loan. What about differences in coupons? What we're looking at here are two bonds, very similar, 10-year bonds, the same rating type bonds, but they have different coupons. And what we can see here, obviously, is first of all, we have different prices. The higher the coupon, the greater the price will be, the greater the return will be to the investor, right? So the other important part here is to kind of look at slope. And these slopes are pretty close together. But what we can see is the bond A, the blue bond, declines a little bit more than the other bond. There's a slight difference in how much it declines. So bonds are sensitive to interest rate changes. And here we can see through a different size coupon, prices do not fall equally. Some bonds are more sensitive to interest rate changes than others. In addition, we also know that time has an element here, right? Bonds with longer times until maturity are more sensitive to interest rates than short-term bonds. So here you see a one-year bond, the blue bond, as interest rates increase, prices decrease, but it's a very, very low slope, right? It is negative, but it is a lower slope. It's not as steep. For a 10-year bond, same coupon, we see a dramatically different decline in value and returns for these particular bonds. Why? Because they are more sensitive. So longer term bonds are more sensitive than shorter term bonds. I look forward to seeing you next video.